China has responded to the latest round of US tariffs with direct financial measures that have immediate consequences. In the span of just one day, more than $120 billion in American market value was affected through bond sell-offs, frozen contracts, and suspended investments. The White House was quick to hold emergency meetings as major sectors, particularly tech and manufacturing, saw sharp losses. This marks a shift in how China is choosing to respond. Rather than continue stalled negotiations or issue formal statements, Beijing acted through markets. It pulled funds from key industries, delayed joint projects, and signaled that further exits are possible. The scale of the pullback caught many in Washington off guard. Inside the Oval Office, the administration is weighing its next step, but the damage may already be done. With rising inflation and global instability, the margin for error is shrinking. But how are situations unfolding? What response does the US have to China? Let's find out. How we got here, from trade tariffs to economic Armageddon. The warning signs were there, but few expected the standoff to unravel this quickly. After winning re-election in 2024, President Trump returned to the White House with a renewed focus on reshaping global trade. By January 2025, one of his first major economic moves was a sharp increase in tariffs on Chinese goods, raising rates on electronics, metals, and consumer products from 10% to 25%, with a promise to push them even higher if Beijing didn't play fair. At first, China said little. There were no press conferences, no fiery statements. For weeks, it looked like Beijing might return to the table, but behind closed doors, talks stalled. By March, negotiations had collapsed entirely, with US officials citing a lack of progress, and Chinese diplomats walking away without setting a date for further discussions. That's when the escalation began to feel like something else entirely. By April, tariffs hit 34% across a broader range of goods, including high-tech components and semiconductors. The impact on US firms was immediate. Several major chip and electronics manufacturers saw orders halted and partnerships suspended. In parallel, China implemented its own countermeasures, introducing 84% tariffs on US farm goods, autos, and industrial equipment. The back and forth played out like a chess match. Washington moved aggressively on trade deficits. Beijing responded with long-view strategies, shifting contracts, pulling investment, and avoiding direct engagement. Where the US used tariffs as blunt instruments, China applied financial pressure with quiet precision. What makes this phase different is the speed. In just 3 months, what started as another tariff round evolved into a larger economic rupture. Washington's aggressive posture collided with China's long-held approach of strategic restraint, and this time, Beijing chose to act instead of wait. Before the end of April, multiple American industries, from agriculture to advanced manufacturing, were reporting multi-billion-dollar disruptions. What began as a policy dispute is now bleeding into core sectors of the economy. The breakdown didn't come from one dramatic moment. It was a series of decisions, pauses, and reactions, each one narrowing the path to resolution. Did Trump overestimate US leverage or underestimate China's patience? Let's look closer at the first major blow China delivered in this economic confrontation: its sudden withdrawal from the US bond market. The $120 billion retaliation, what China really did. When China finally responded, it didn't do so with words or press briefings. It moved capital and fast. The retaliation began with a quiet but decisive sell-off. According to the Peterson Institute for International Economics, Beijing unloaded more than $40 billion in US Treasury bonds within the first 48 hours. By the end of the week, that figure had surged past $120 billion as state-owned banks and sovereign wealth funds followed suit. The bond market jolted, yields spiked, investors scrambled to assess the fallout, and for a brief window, demand for US debt wobbled in a way not seen since the 2008 financial crisis. Then came the divestments. Major Chinese stakeholders began pulling back from high-profile US ventures. Investments in renewable energy startups were shelved. Acquisitions in Silicon Valley tech firms were abandoned. Commercial real estate sales followed, especially in high-value zones like Manhattan and Los Angeles, where Chinese ownership had quietly accumulated for over a decade. Beijing's next move was surgical, a halt on semiconductor imports from key US suppliers. Companies like Intel, Qualcomm, and Texas Instruments found deals suspended or delayed without notice. In industries where timing is everything, even a short pause can send ripples across production lines. The reaction was swift. Within 72 hours, at least 3 major US semiconductor firms issued downward revisions on earnings forecasts. Stock prices dipped across the board. Layoffs were announced in Austin, Santa Clara, and parts of Arizona. These weren't just job cuts, they were direct hits to the country's tech backbone. For many in the private sector, it felt like deja vu. Supply chains, already strained post-COVID, began to tighten again. Assembly plants that had only recently stabilized reported delays in sourcing key Chinese components. Small and mid-sized businesses were especially vulnerable. Many didn't have the buffers or alternative suppliers to weather another wave of disruption. And all this happened without China matching tariff for tariff. Beijing didn't just respond within the rules of trade negotiation, it stepped out of the arena and rewrote the rules. Rather than reacting with public threats, it attacked from pressure points Washington had overlooked: capital markets, high-tech dependencies, and strategic investment channels that hold deep influence but rarely make headlines. This wasn't just retaliation, it was redirection, and it landed. If the financial hit was brutal, the tech retaliation might be even worse, as we explore how China's abrupt decoupling from US chip makers may shift the future of the global technology landscape. Tech decoupling. China goes for the jugular. China's response to the trade war was calculated and brutal. The moment Beijing severed its semiconductor ties with the US, it wasn't just a blow to trade, it was a declaration of a new phase in the global tech rivalry. The first domino fell with the termination of key contracts between Chinese companies and American chip makers. Firms like Nvidia, Intel, and AMD found themselves with their largest buyer no longer at the table. But the move didn't stop there. Beijing placed a hard ban on any further cooperation with major chip suppliers like ASML from the Netherlands and Taiwan's TSMC, the two companies that power the global semiconductor market. Without access to ASML's cutting-edge lithography equipment and TSMC's world-leading chip fabrication capabilities, China was forced to look inward. In a show of defiance and foresight, Beijing announced the creation of a colossal $47.5 billion domestic chip fund, aimed squarely at cutting China's dependence on Western technology. The initiative seeks to develop a fully self-sufficient semiconductor ecosystem that could rival even the US's dominance. China plans to pour billions into artificial intelligence, AI, and quantum computing sectors, which could position it as the future leader in these emerging fields. The ramifications for US tech companies were immediate and devastating. Within weeks, firms like Nvidia, Intel, and Tesla saw massive drops in revenue projections. What had been a reliable and lucrative market for years suddenly vanished. Stocks in the tech sector took a beating, and within a month, $2 trillion in market value was wiped from the industry. This isn't just a trade dispute anymore, it's a high-stakes battle for the future of global tech. As China advances in its self-sufficiency, the US faces a critical question: how will Washington respond? The tech Cold War has begun, and the next phase could have dire consequences for America's global leadership. We'll dive into how this escalating tech decoupling might reshape the global order and what it means for US dominance in the years to come. Wall Street, Main Street, and the worker. The effects of China's retaliation reverberated far beyond the halls of Washington. On Wall Street, the fallout was immediate. Major indices plummeted, investor sentiment took a nosedive, and the fear index spiked as recession talks were once again thrust into the spotlight. But the real pain was felt on Main Street, where the consequences of the trade war began to hit home for average Americans. In tech hubs like Silicon Valley and Austin, layoffs were swiftly announced. Startups that relied on Chinese markets for revenue were forced to pivot or shut down. Meanwhile, established companies like Intel and Nvidia found themselves reeling from the sudden loss of a crucial market. The damage wasn't confined to tech either. Manufacturers in places like Detroit and Chicago, already struggling from supply chain disruptions, now faced even greater hurdles as parts from China dried up. The ripple effect extended to consumers, who found themselves paying more for everyday goods. Electronics prices surged as shortages in semiconductors and other crucial components drove up costs. Electric vehicles, a key part of the green energy transition, saw production slow as suppliers faced growing delays. Industrial parts for everything from construction to healthcare were suddenly in short supply. The knock-on effects were felt not just by consumers, but by businesses of every size. The pressure on US companies to adjust, adapt, and navigate new global supply chains was immense. Startups and small businesses struggled to stay afloat as their costs soared, while conglomerates scrambled to mitigate the damage. But at the heart of this storm lies a bigger game, one about more than just dollars and jobs. It's a battle for control, influence, power, and that's where things get even more complicated. The geopolitical blowback. Who's watching? Who's joining in? As the US-China trade war escalated, China wasn't just looking at the immediate economic fallout, it was also thinking on a global scale. In one of the most strategic moves of the conflict, Beijing sent a powerful message to the global south. We don't need the US market to win. This wasn't just about retaliation, it was about positioning China as the new economic leader of the world. And across the globe, nations were starting to listen. The BRICS nations, Brazil, Russia, India, China, and South Africa were already closely aligned, but now they were pulling closer together. With Beijing's increasingly aggressive stance on trade, these emerging powers found themselves on the same side of a rapidly shifting global order. Oil-rich Gulf nations, once steadfast allies of Washington, began exploring new avenues for energy trade, with China stepping in to offer better terms, often in yuan rather than dollars. Meanwhile, Africa and Latin America, regions often overlooked by the West, were accepting Chinese currency for trade, signaling a monumental shift in global financial systems. This new trend threatened the dominance of the US dollar, potentially signaling the end of its reign as the global reserve currency. Even Europe, traditionally aligned with the US, was feeling the pressure. With trade ties to both Washington and Beijing, Europe found itself balancing precariously on the edge, trying to avoid being swept into the whirlwind of rising tensions. Closer to home, Japan and South Korea watched in quiet concern. Both nations, long-standing allies of the US, now face the uncomfortable reality of being caught between their economic interests with China and their security obligations to Washington. But as the global stage shifts, the question remains, what's next for the man at the center of it all, President Trump? Trump's gamble, genius leverage, or costly miscalculation? In the Oval Office, President Trump's words were clear: we will not be bullied. With every escalation of tariffs, every diplomatic snub, he doubled down on a strategy that felt more like a declaration of war than negotiation. The question now on everyone's mind, is this a bold play for long-term American dominance? Or is it a reckless gamble that could jeopardize the country's economic future? Inside Washington, the divide is stark. On one side, the trade hawks, those who've long advocated for aggressive tactics against China, applaud Trump's moves as a necessary step toward reindustrializing America. They see this as a much-needed recalibration, pushing back on China's growing economic power and forcing US industries to retool and revitalize. But on the other side, the market realists are sounding alarms. They worry that pushing China too hard could trigger a systemic risk, crippling global supply chains, derailing tech industries, and plunging the US into a recession. Meanwhile, US allies are growing increasingly uncomfortable. Countries that rely on trade with both the US and China are urging Trump to seek a negotiated settlement, fearing the long-term consequences of further alienation from Beijing. But is this simply a tactical maneuver, part of a larger Trump doctrine to reshape global power dynamics? Or is it the overreach of a president pushing the limits of his second-term mandate? As the stakes rise, the question remains, where does America go from here? What we're witnessing is far more than a simple trade dispute. This is a battle for the future of global economic architecture, the $120 billion lost overnight. That's not the headline. It's merely a signal of the changing balance of power, a stark reminder that leverage in the global economy is shifting. The real question now, is the US prepared for a future where China no longer plays by the Western rules of engagement? The trade war might have started over tariffs, but it's evolving into something much larger, a redefinition of how global markets operate, who controls the flow of capital, and who sets the terms for technological dominance.